because they can only lend it like 8 or 9 times and then they're out of money.
The fractional world we live in.
Yeah, it makes no sense how that works to me, but hey, I'm not a banker. Apparently we're in the wrong field though, I guess.
Yeah.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old-fashioned real estate advice.
Episode 40.
Welcome back to the Old Fashioned Real Estate Show. I'm Brian Leverage.
And I'm Jeffrey Holst. And Brian, it is great to be back.
Yeah, absolutely. I think it's been a number of months since we've actually been in the same room filming, isn't that right?
It's definitely true. We're, I think, enough socially distanced that we're safe now.
Yeah.
Yeah, it's almost June. The last time we filmed in the same room was
in January.
January, yeah. So nearly 6 months without filming in the same room. Cameron, our camera guy, is excited to be back, I'm sure. We've done some other interview type shows and stuff, which I'm sure you guys loved, and we've been really enjoying those. But it's really good to be back. So Anyway, we have an interesting topic for today. We're going to talk about
banking.
Yes, in particular, how to get financing today, because it's different now than the last time we did an episode on how to secure bank financing.
Which you can refer to up
there. Yeah, I don't remember what episode it was, but it was that one right there.
Yeah, so essentially, we're bringing some additional information to you in the hopes that you can utilize it in your investing career. As Jeff mentioned, the world we live in today is different than 3 months ago. And so with that being said, you know, a lot of investors, and we're not immune to this ourselves, are seeing increased pressure, you know, from lenders to try and get deals financed because they're running into resistance. The lenders are uncertain. And what that means is that, you know, it might make your deal a little less financeable than it was previously, right?
Sure. And there's been a lot of delays in the lending market, too, because of the PPP loans. A lot of the banks just shut down doing traditional lending for a period of time so that they could process a huge influx of bailout loans. So we're in a sort of unknown environment where rates are falling again. They went down fast and then went up fast, and then now they're back down. Who knows where they'll be when this episode comes out? But there's a lot of uncertainty in the market, and this is a time when I think relationships are going to matter probably the most. So there's a couple different things that we're going to get into today, but you know, the first is that I'll probably stipulate right now that generally, you know, if we're talking about the BRRRR strategy, which is a real popular one out there. Just to be clear, BRRRR is buy, renovate, rent out, and refinance.
Yes.
And then essentially an option to get into your property with little or no of your own money.
Right, right. Now, if you're using some type of hard money or cash purchase on the front end and then you're holding it the requisite seasoning period, it's my understanding that Fannie Mae and Freddie Mac still will do the cash out refis on those.
Yes, I believe if you have it for 12 months or more, the cash out refinances can still occur. I think they're still being a little bit more picky on them than they were 6 months ago when we last met, but it's definitely something that can be done.
Yeah, but a lot of what we're going to discuss today will tend to focus more on, you know, commercial loans, you know, with portfolio banks, community banks, etc., than larger big box banks. So yeah, that being said, I mean, having just talked about the BRRRR, you know, and sort of expanding on that topic a little bit, right now lenders are very averse to doing cash out refis. You know, they're wanting documentation on why that is, and they're just not looking to give money back out right now.
Yeah, I mean, I've heard of people getting them done, so it is possible. But you need to have a really strong financial position, and you need to be looking at lower loan to values, things like that. You know, we were very fortunate. We were able to do one of our refinances, not Brian and I, but one of my other partners' refinances and I. We did it and closed it the first week of March. But it would have been in the works for a while. And when we got done with that, We were looking at another apartment complex that we were going to refinance that was in the process at that time, and we still haven't completed that loan. So now we've owned it for, well long enough that it makes sense that we have a pile of equity in it, but the banks they're not saying no. They're actually just being very cautious and slow to get it done.
Yeah. And I think really the purpose that should serve for you, the investor, is that you need to probably do additional underwriting or be more conservative in your approach when looking at these things. So you might want to shock them a little bit more than what you normally would, just to sort of account for some of that increased risk that the lenders are looking at. Because in talking to some of the banks that I work with, they are shocking them harder than they normally would. So if they're using a 30 to 40% expense ratio and then calculating NOI and debt coverage based on that, they might bump that up 5 to 10 points just to sort of account for that.
Right. So they're looking at a way to account for the additional risk, because we really don't know. I mean, as we sit here today, it's still in almost all jurisdictions in this country, probably in the whole world, impossible to move forward with evictions. And so if people aren't paying rent right now, we have no idea when they would be.
That is about to change imminently in Tennessee, I'm told.
Right. Well, sure. But I mean, as we sit right now, that's not the case. And
certainly by the time this airs, though.
Well, we hope so. We hope so. But the thing is, the banks have this unknown risk, and they're pricing that into higher rates in some cases by increasing the spread, and then also by eliminating risk by doing shorter terms of amortization, and also requiring, higher cash injections and not doing cash out refis like you were saying. But the topic was how to sort of move forward in this new environment. And, you brought up shopping to multiple banks. That's something that, frankly, people should be doing anyway, right? Because one bank might have appetite for a cash out refi, or they might have appetite for your new purchase, where another bank might not. And you don't know, right? You might have a bank that June 1st says, you know what, we're good to go on small multifamilies. And, in May they weren't. It can change literally from day to day. Mm-hmm. So we have to just kind of, build that relationship, present the numbers. And frankly, if you're a strong borrower, the banks still need to do business. They make their money by loaning money out. So they're going to do that job. And they're going to figure out how to loan you money as long as they feel that the risk is acceptable.
Yeah. I think what you really need to do too is you have to look at focusing on strengthening your balance sheet as well, because whereas some lenders might look more at a project in the past, they're certainly still looking at the project, obviously, but now they're looking at you maybe a little more than they would have previously.
Yeah, look, there's always been two factors, right? The project has to support itself. It has to meet the debt coverage ratios that the banks require, and that might be higher now than it was before. That's part of pricing and risk, where they might have wanted a 1.25, maybe they want a 1.3 or a 1.35 now. So they're going to look at the project and make sure the project supports itself, but they're also going to look at your personal liquidity. They're going to look at, how much other debt you have, what other guarantees you have, what your cash flow looks like. Huh.
So it would behoove you to basically make yourself look as strong as you possibly can on paper before going in for a loan request.
Of course, it's good for you anyway to be strong on paper, because that means you're in a better financial situation. So if you have some high interest rate debt, one option might be to refinance and not look for a cash out refinance, right? Get that payment down, which increases your cash flow.
Yeah.
Take that as a stepping stone.
Or, if you have significant deposits at one financial institution and you're not really doing a lot of business with that financial institution anymore, you could look at moving those deposits over to one of the other ones, because most lenders, again, they're in it for the relationship. It's not just about the loans and the money walking out the door. They're looking to bring, deposits in so that they can continue to lend, of course.
Right, because they can only lend it like 8 or 9 times and then they're out of money.
The fractional world we live in.
Yeah, it makes no sense how that works to me, but hey, I'm not a banker. Mm-hmm. Apparently we're in the wrong field though, I guess. Yeah. So.
And then I think, sort of a final point to some of this is, taking a look at the asset classes too. I mean, you might be a commercial guy or a spec home builder or something, But, if you're an investor that kind of dabbles in certain things, you might need to look at adjusting strategy at least for a little while. I mean, right now, residential home sales and new construction under certain price points they're selling faster than they can be finished, or as soon as they're hitting the market generally. But, something like commercial property, which we have some exposure to, leasing's a little slower now on some of that stuff. And rent collections are a little tougher, so...
Yeah, and the thing you don't know is if you are getting into like new construction, like you're going to build a single family home or something, you don't know what the market's going to look like in a year. It's really hard to predict what's going to look like a month from now right now, because if everything opens back up, which, it seems like we're moving in that direction, it might be fine. But if we get a resurgence of this disease and we end up in in an extended shutdown, people might not be they may just frankly not have the ability to buy a house, and then it won't sell. Mm-hmm. So far, the lending has tightened up for guys like us, the people that are investing in real estate, and it hasn't really tightened up for individual home buyers, which means that the limited inventory that's out there is still selling relatively quickly.
Yeah.
But we just don't know. The guidance changes constantly on this stuff. There could be other rounds of stimulus which might impact this as well. We just really don't know what's going to happen. So,
any final points?
I still think it's a good time to look at refinancing. Rates are low. Even if you can't pull cash out, if you're sitting on a rate that's in the low fives, like a lot of people are, that people that have had their properties for a year or two. You probably can get a point or so off of that, and that can make a huge difference in your cash flow, which makes you look better on paper, makes it more likely you can get that next loan. And a lot of times if you go to your bank that's currently lending and you say, look, I can go refinance this somewhere else, they'll actually just do a low-cost refinance for you. Mm-hmm. And we've had pretty good luck with that in the last few months, actually. We've been able to do about 2 or 3 of those. So
yeah, absolutely. Absolutely. So.
And saving significant amount of money too. On one deal, it saved almost $1,000 a month, and the cost was like a couple $1,000. So you get it back in 2 months, and that's it's not
significant
terrible.
ROI. Yeah.
Yes, it's a good return on investment. So anyway, thank you for joining us for this episode of the what show is this?
The old-fashioned real estate show.
Yeah, you can tell what show I've been filming lately. Wow. Yeah, the old-fashioned real estate show, clearly my favorite show that I've ever done today. And anyway, we really appreciate it. If you haven't subscribed already, we're in a neck and neck race with another channel to make it to 1,000 subscribers before them. I don't know if you knew this or not, but I have a little friendly competition going on Facebook. So if you haven't subscribed already, we need you to subscribe right now. If you have 25, 30 friends, get them to subscribe also, because we need to get to 1,000 subscribers by the time this video comes out.
Perfect.
Yeah, so I don't know if that'll work or not. We're not anywhere close though. So anyway, thanks again. We really appreciate it.
Have a great day. Cheers.
Wait, we have to do our cheers. We haven't filmed it so long we forgot how to film.